$1 trillion. That is exactly what was vaporized from the precious metals complex in a window of just 80 minutes this morning. Not a week, not a month, 80 minutes. Gold dropped 2%, instantly erasing roughly $740 billion in market capitalization. Silver plummeted between 10 and 11% in that exact same window, erasing around $260 billion. Stop and process the sheer mathematical violence of that event. You do not wipe $1 trillion of value from physical, historically anchored assets in the time it takes to commute to work because of a natural shift in retail sentiment. That is not a market dynamically reacting to organic news flow. That is a market being forcibly, systematically moved. That is a targeted deployment of paper leverage designed to trigger algorithmic cascades and margin calls. The mainstream financial media will package this for you neatly. They will point to a 1% surge in the US dollar, which is now challenging highs not seen since January 15th. They will tell you it is a simple, textbook inverse relationship. The dollar goes up, so metals must go down. They will point to the DAX dropping 4%, NASDAQ futures peeling off 2.5%, and S&P futures down 2%. They will frame this as a standard risk-off liquidity squeeze. But a 10 to 11% concentrated crash in silver inside of 80 minutes goes well beyond the textbook macro explanation. It defies the structural reality of what is happening on the ground. European natural gas surged 20 to 22% today, piling directly onto the 50% it gained yesterday. That is a 70+% explosion in European natural gas in exactly 2 days. That is not a blip on a chart. That is a market aggressively pricing in genuine, sustained energy terror. The Curry and Kospi closed Monday for a holiday and reopened today for the first time since U.S. and Israeli military action on Iran began. It immediately crashed over 7%, erasing $270 billion in market cap in a single session. That was the largest single-day plunge in Korea since the August 2024 yen-carry trade crisis. It was pent-up selling pressure from a market that could not react for 48 hours. Finally getting its moment to price in geopolitical reality. You have an expanding Middle East war, oil infrastructure getting systematically targeted, and critical energy routes collapsing. And in the middle of that supply shock reality, silver drops 11%. The algorithms look at the energy disruption, see a supply shock, immediately price in a global growth scare, and mechanically hit every single industrial metal. Silver carries roughly 50 to 60% industrial demand for solar, EVs, electronics, AI infrastructure, and defense manufacturing. Energy disruption of this scale hits those demand projections directly. Because gold has no factory that inherently requires it, it holds its ground better. When growth fears dominate, the algorithmic order is always the same. Gold first, then silver, then platinum, then copper. The more industrial the metal, the harder the automated systems punish it until growth uncertainty fades. That is the surface-level illusion. The algorithms sell the paper. They dump the futures contracts. But paper is not physical. The mainstream wants you focused on the red candles. I want you focused on the underlying vault math. This is not about validation. This is about data. You are about to see exactly what institutional panic looks like when the paper construct detaches entirely from the physical foundation. The mainstream consensus will feed you a comfortable lie. They claim this historic 11% crash is simply a natural byproduct of a rising dollar and shifting risk appetites. They want you to believe that price action is a random walk, dictated entirely by unpredictable headlines and emotional panic. They sell you the narrative that technical structure does not matter during a macro liquidity event, that markets are just reacting blindly to the news cycle. They want you focused on the noise, so you remain blind to the architecture of the move. Not random chaos, but systematic structure. Not a surprise, but a calculated technical failure. Let us pivot to the tape. What follows is strictly educational, not a signal. Yesterday, the underlying structure offered a binary reality. The objective setup was mapped out before the trapdoor ever opened. The specific warning was clear. If silver failed to hold the 150 exponential moving average on an hourly chart near $90, we could move down to $84.90 and below. You must understand the mechanics of the 150 EMA. It is not a theoretical line, drawn by retail day traders hoping for a bounce. It is the algorithmic boundary of institutional momentum on that specific time frame. It represents the weighted, dynamic average of where serious capital has previously stepped in to defend the trend. When price tests that moving average, it is testing the liquidity and conviction of the buyers. When it breaks, the market is not just slipping. It is actively repricing. It is triggering thousands of automated programmatic stop-loss orders. It is a mechanical failure of momentum that forces algorithmic systems to flip from net long to aggressive short selling. The level did not hold. Silver broke down technically. The 150 EMA on the hourly failed, and the consequence was immediate. Lose that 150 EMA on an hourly close, and the trajectory is explicitly lower. Period. Here we are. Western spot silver is sitting at $79 as this recording is made. Western futures are trading at 81. This was not a scattergun approach, offering 1,000 different scenarios to cover every possible outcome just to claim victory in hindsight. This was one scenario, dictated by one specific level. When the level broke, gravity took over exactly as stated. In a full liquidity squeeze, even structurally sound assets get liquidated violently for cash. The macro headline simply provided the kinetic energy to execute the technical breakdown. Look at where silver is actually trading, depending on which market you interrogate. Not the headline paper price, but the physical reality. Western spot sits at $79. Western futures sit at 81. Now look, East Shanghai spot is at 91. Shanghai futures are at 92. That is a $12 premium. A $12 premium that remained completely intact even after an 11% crash in the West. You do not sustain a $12 arbitrage gap in a globally traded, highly liquid commodity by accident. It is the physical market screaming that the paper price is a fiction. Let us deconstruct the ratios. The math does not lie. That is the illusion. Now measure the physical foundation. The mining ratio, how much silver actually comes out of the ground, above ground available supply, is 1:1. One of those numbers has to snap hard. A paper ratio of 62:1 is so completely disconnected from every physical and production reality that it resolves eventually. The math alone guarantees it. At the exact same time, February 24 through the 27th, the silver inventory data is completely gone. And now, during a historic price surge and active geopolitical chaos, they go dark on the one number that matters most. Over the past several days, lease rates have been creeping higher. In normal, well-supplied conditions, borrowing metal is cheap and orderly. It means the cost to borrow actual, physical silver is escalating violently. The paper price plummeted to 79. The physical stress indicators are accelerating in the exact opposite direction. Look at the COMEX vaults. On Friday alone, 2.8 million ounces were withdrawn from COMEX silver vaults, pulled simultaneously from Brinks, CNT, Delaware, and JP Morgan. Eligible silver is falling faster than registered silver is rising. Total COMEX inventory is still net declining. March contract open interest still sits at roughly 222 million ounces. Registered silver, the metal actually available to fulfill a delivery request, is at 88.19 million ounces. That implies a deficit of well over 130 million ounces between what is theoretically owed and what is physically deliverable. Do not let anyone distract you with a rising registered headline. The full picture is draining. Then look at the players. Jane Street is now the largest holder of the BlackRock Silver Trust. 20.6 million shares purchased in a single quarter. That is 3.6% of all outstanding shares. Over 87% of their $662 billion portfolio is held in options. They do not invest. They generate profit by creating and trading volatility using massive leverage. The institutional structure is straightforward. Build a large position in the underlying asset. Run a significantly larger derivative trade on the side. Move the price. Collect the premium. Who holds the physical silver backing Jane Street's SLV position? JP Morgan. A bank that already paid nearly $1 billion in fines for manipulating precious metals markets. When the firm that stores the metal and the firm that owns the most shares both carry documented histories of market manipulation across multiple asset classes. An 11% crash concentrated into 80 minutes before the New York Open is not an accident. It is an operation. Verify this yourself. The reports are public. The microstructure of the metals market is fracturing because the geopolitical bedrock underneath it is already broken. The anomalies in the vault data do not exist in a vacuum. They are the immediate, localized symptoms of a macro system actively buckling under the weight of state-level fragmentation, sovereign debt saturation, and energy supply chain collapse. Look at the energy grid. The Port of Fujairah, the UAE's only significant oil shipping route designed to completely bypass the Strait of Hormuz, was just hit by a massive explosion. Iran is not just threatening the primary strait. They are directly and systematically targeting the vital workaround routes. Simultaneously, Iraq has shut down Rubillah, that is the world's second largest oil field. instantly removing 1.5 million barrels per day from the global market, representing roughly 30% of Iraq's total output. You must understand the logistics mechanics of this disruption. When tankers cannot safely move through the Gulf, localized storage fills rapidly. When storage hits maximum capacity, production must mathematically stop. That is exactly what is happening on the ground. The United States has warned of imminent Iranian missile and drone attacks targeting Deir in Saudi Arabia, the operational heart of Saudi Aramco, and the largest proven oil reserves in existence. The fracture lines are fully drawn, with the U.S. and Israel on one side, and Iran with Chinese diplomatic backing on the other. As the U.S. president stated publicly, "We haven't even started. The big wave hasn't happened." 15 countries or military installations have already been struck. The largest Saudi refinery was taken offline, and Qatar's LNG routes are compromised. Physical supply pressure in the energy markets is aggressively overcoming paper selling. Now map that exact sovereign instability directly onto silver supply. Mexico remains the world's largest silver-producing country. Roughly 1 in every 4 ounces mined globally comes from that soil. A top-tier cartel leader was eliminated in a military operation, triggering immediate airspace shutdowns, road blockades, and military mobilization. The mainstream reads that operation as a victory for regional stabilization. They are wrong. History proves that cartel leadership takedowns do not create instant stability. They create violent fragmentation. Power structures reorganize, extortion rackets, inflate operating costs, and logistics freeze. This has escalated to the point where the U.S. administration is openly floating direct military intervention. The precise statement offered to send the U.S. military into Mexico to take control of the cartels directly. Any sustained disruption to Mexican mining security is an immediate, unhedgeable supply shock injected into a market that is already running a compound structural deficit. The vulnerability does not stop at physical supply chains. It extends directly into domestic credit and labor. There is a $2 trillion private credit market, quietly funding the physical backbone of the artificial intelligence wave data centers and compute capacity. One key lender managing $273 billion in assets recently restricted withdrawals from a $14 billion retail fund. When an institutional fund restricts withdrawals, it is a glaring red flag regarding its liquidity to meet basic obligations. The companies borrowing from this shadow system carry extreme debt loads. AI is working, but it is working faster than the traditional labor economy can adjust. If AI systematically reduces the cost of tasks historically performed by white-collar workers, who represent half of U.S. employment and drive over 60% of total consumer spending, you get a violent wage-based contraction. That contraction feeds directly back into housing, credit defaults, and government tax revenue. It is not a theoretical model. It is an economic loop that is aggressively deflationary for labor income and highly inflationary for hard assets. Finally, look at the sovereign debt layer. The Supreme Court just ruled emergency tariffs illegal, creating a potential refund exposure of $150 billion. If those refunds are approved, the government faces a massive immediate revenue shortfall that mathematically demands additional borrowing, putting violent upward pressure on Treasury yields. The U.S. dollar's share of global reserves just hit its lowest level in 32 years, currently sitting at 56.9%. Central banks are not cutting dollar exposure on a whim. They are executing a calculated exit because the terminal math of U.S. debt makes the shift unavoidable. Even in an optimistic scenario with 0 recessions for 10 years, U.S. debt is projected to hit $64 trillion by 2036. The physical silver deficit, the cartel fragmentation in Mexico, the energy chokeholds in reds of millions more. The coverage ratio has collapsed to a catastrophic 0.14. You must understand the mechanics of that metric. It means for every single paper contract that can theoretically demand physical delivery, only a fraction of an ounce actually exists in the vault system to satisfy it. At the exact same time, UBS officially projects a 300 million ounce silver deficit for 2026. That is not a minor cyclical shortfall. That is roughly 40% of the 800 million ounces the entire world extracts from the ground annually. It marks the 6th consecutive year of a structural deficit, and it is actively compounding. 0 global gold discoveries have occurred in 2 consecutive years. That has never happened before in recorded history. Central banks are systematically abandoning the U.S. dollar, pushing its global reserve share to a 32-year low of 56.9%. Gold just posted its highest weekly close in recorded market history, above $5,100. It absorbed a Supreme Court tariff flush, shook off the algorithmic selling, and moved immediately higher. Meanwhile, a $2 trillion private credit market is exhibiting severe liquidity stress. Artificial intelligence is fundamentally displacing the white-collar labor force that historically drives us consumer spending. Sovereign debt is structurally programmed to hit $64 trillion by 2036. And that is an optimistic baseline without a single crisis catalyst. And the world's largest silver producer is dealing with military mobilizations, airspace shutdowns, and immediate cartel fragmentation. These are not isolated data points. Not a coincidence, but a convergence. This is the global monetary regime shifting in real time. The paper market is aggressively pricing a reality that no longer exists physically. Reckoning is mathematically unavoidable. You do not have to predict the exact day the paper structure breaks. You only have to recognize that the math guarantees it will. Verify every single piece of data presented here. Pull the COMEX inventory reports. Read the institutional deficit projections. Look at the central bank accumulation figures. The data is entirely public. The reality is completely undeniable. This is financial warfare education, not advice. Protect your capital. Invest with logic, not hype. ICN can occur. In the East, the Shanghai session opened at $99, spiked to $102, but settled lower at $96. It did not hold the $100 psychological level. That confirms genuine, heavy selling pressure exists above 100. Just because Shanghai holds a $10 premium does not automatically mean Western spot will surge upward to close the gap. It could mean Shanghai physical prices correct downward to meet the West if the localized demand signal fails to sustain. Then there are the macro fades. Geopolitics is a pendulum. The Iran strike deadline is 10 days out, but a sudden diplomatic deal could be struck overnight, instantly removing the embedded conflict premium from the energy and metals markets. The US dollar recently posted its best week in months, and a strong dollar creates immediate mechanical headwinds for any asset priced in US. If the private credit stress visible in the data does not immediately produce a systemic public bankruptcy event, institutional capital will stubbornly remain parked in technology equities. The COMEX February delivery anomaly is historically unprecedented. But bullion banks possess a documented history of engineering bailout resolutions in prior episodes without allowing a full market dislocation. These are real variables. They are not excuses. Anyone managing actual capital has to account for them. Let us synthesize the data. Not the mainstream headlines, but the verified, structural math. $1 trillion was vaporized from precious metals in 80 minutes. Silver crashed 11% in a single session. But the physical market did not flinch. It detached. Shanghai maintains a massive persistent premium over the West. The paper gold-to-silver ratio trades at an illusionary 62-1, while the actual physical mining ratio sits at 1-7, and the COMEX vault ratio is backed into a corner at 111. COMEX registered silver is bleeding out. It currently sits at 88.19 million ounces against a paper open interest demanding